Welcome to Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX, and again on Saturday morning at 9 on KATX and KWBY as Angela Robinson joins Terry Slavens to share important financial information to help you live life on purpose. Insurance, investments, estate and tax planning, and much more. All covered now on Life Planning 101.
And welcome into Life Planning 101 on KTX KWBY. Terry Slavens with you, and we're joined today by Angela Kennedy Robinson and Aaron Kennedy.
That's right. Good morning.
Good morning, everyone. Where's the year going?
I know.
Last week we talked about you got 52 weeks. You're
That's
down
right.
To 51.
Now we're down to 51, and it's time to get serious.
That's right.
So and actually, we do have more of a serious. Anytime we have Aaron on, it seems to be more serious because that's the nature of your job. I guess.
That's very boring.
Yeah. I guess this is why you're always scratching your head behind your desk. But anyway, we're very lucky to be able to have Aaron on for the show this morning. He's our in-house charter financial analyst, and all he does is really watch what the markets are doing, watching investments, talking to other money managers, other experts in the industry, and really understanding what is going on out there, and then taking that back to the people that we work with, the families we work with. So we're very blessed to have him on the show for the full show this morning.
Full show and somewhat of an important job.
Yes. Very important.
I hope so.
Yeah, very important.
Job security, Aaron.
It is job security, no doubt. So, and we wrote an article this week, and I encourage everybody to get on and read this. It's on Kennedy-financial.com, and it's called Avoid These 3 Most Common Pitfalls of Investing. And they're really good. We're not going to really get into the meat of this article, but the whole gist of the fact is that there's really a lot to be able to look at, and the lot to be able to look at is really what we're going to talk about on the show. Because a couple weeks ago, we decided, hey, we need to get some, I don't know how you say this, get some, things done on the show to be able to help people understanding what the basics are of investing and really what they're looking at when they look at things. And just to, I ran up some quick facts and figures for us to start with, Aaron, because I thought this was amazing. On Investopedia, it says there are 630,000 publicly traded companies throughout the world right now.
It's incredible, isn't it?
Yes.
630,000?
Yes.
Wow.
So sorting through those, right? And then on top of that, you look at Vanguard last year, they said in the U.S. alone, there is 8,794 mutual funds and exchange-traded funds in our markets. So, how do you sort through all of that and look at it? I mean, what should you look at as an investor? Where do you even start?
That's a good question. There's a lot of noise out there when it comes to investing, really. There's, like you said, 8,700 mutual funds and ETFs, and there are so many of those that are duplicates of one another, or what they call closet indexers, things that follow an index very closely, but you're paying a very high fee to get what you can get somewhere else for next to nothing. So I think the first step to knowing where to go is to see what your objectives are, see your risk tolerance, and have kind of a broad view of what you're looking at. Because the market is greater than the S&P 500. So, if there's, what did you say, 630,000 stocks in the world?
Yes.
And then everybody's judging their investment portfolio by 505 stocks in the USA.
Right.
I mean, that's kind of silly.
Yeah.
I mean, really. And to look at a different way, the S&P 500, it's a market cap weighted index, which means if you take those 505 stocks and you weight them by size, that's going to be the largest holder. You have Apple, which its weight in S&P is around 3.5%. Then Google's on up there too with about 2.8% of the entire index, and it weights all the way down to companies that are 0.008%.
Wow.
So
they really don't.
Market?
They really don't even drive the market when they're that much of the index. Wow.
No, it doesn't. I mean, it doesn't even register.
Yeah.
So,
I think, what was it, a couple of years ago, last year we talked about FANG, the Facebook, Amazon, Netflix, and Google effect in the market, and how really if you pulled those out of the S&P 500, the U.S. markets performed negatively for that year. And it was only 4 stocks pulling up the whole market.
Market would have been down 2 rather than up 2.
Yeah.
And that's remarkable.
That is. So, it's really fun. And I think this is a really good topic because so, many people, especially when they first come to us, and, we're real big on education. We believe in that wholeheartedly. So that's why we do all these newsletters and we have our radio shows on podcasts and this and that, because so many people look at that market on the TV and they believe that that's what is real. Well, is it real?
No. No. It basically boils down to this. I mean, it always boils back down to investor psychology, because we can judge everything against the S&P 500. And guess what? The S&P 500 has been doing great the last 7 years, but the previous 8 years before that, it was the largest laggard. So if you were an investor, you would have not owned it, or you would have owned it when it was doing very poorly and then turned around and sold it and when it started to do good again, and you would have been buying high and selling low over and over again. The better approach to this is to diversify your entire holdings. Yes, it's all right to have a little bit of market cap, weighted index like the S&P, but we need to own small companies because, over time, smaller companies outperform the S&P. You want a good way to do it? Own some small companies. You want to lower your risk and increase your returns? Own some international. That's been very brutal the last 4 to 5 years to own it. But guess what? It's cheap. You can go out and get 4.5% dividend yield on European indexes. That's not bad.
No.
That's not bad. And if we have to get paid 4.5% to wait until things turn around over there, that's not a bad deal.
It's better than 1%.
Yeah, it's better than 1%.
You know how much better that is than waiting till it does turn around to buy it?
Ooh, ouch. Yes. So that could be why, when we look at, and this was actually done by BlackRock, one of the analysts that we like to be able to use, and they did an investor psychology deal, and the average annual return for an investor over the last 20 years was 2.11%. That's it. Whereas the market value of stocks actually returned over 8.19%. So that shows you that emotion that you're talking about.
Yes.
Yep. So when we come back, we're going to get into some more of this nitty gritty about, so people hear international. What does that really mean? Is that something we need to be fearful of? We are fearful when it's things that we don't know. And we always have a saying that a confused mind says no. So let's unconfuse you today and help you understand really what small companies mean, what international means, what mid-sized companies mean, what value means. When we come back, you don't want to miss it.
We'll be back with more Life Planning 101 right after this. And welcome back in. Life Planning 101 continues here on KTX KWBY on this Monday, marvelous Monday in January. Angela Kennedy Robinson and Aaron Kennedy. Take it away.
And that's right. If you're just joining us, we are giving a full show on the interlacings of investing, what all of it's about. We just got through talking about, human behavior, the size of the markets and what's actually out there. And we didn't even mention what's non-traded, things that you can invest in, such as real estate or oil and gas or private debt or private equity, and add on to all of this for other investments or commodities. We didn't even go down that road. So
stocks that aren't traded.
That's exactly right. There's so much out there, and and how do you go through all of it and look at all of it and know what it is? And we mentioned that you really can't just go into the S&P and look at the S&P because, for instance, in 1 year it was only 4 stocks that really made up the returns in the whole country. So that's falsified. So what should you be looking for? And Aaron, right before the break, you talked a little bit about small small companies, and you talked a little bit about international companies. And I think a lot of people have fear when they hear that, because they hear small and that makes them think, ooh, unstable, volatile. They hear international, they think, ooh, I don't know. I just simply don't know. And I love what you always talk about. And I like to start with international, if that's okay, because I love what you always talk about. And this is something I use with clients all the time, because I love putting Nestle's Quick on my ice cream, and that is a Swiss company, Yes. So, but talk to a little bit about, what does international really mean? Does it mean that it is taking a huge amount of risk, or what risks are really the inherent risks with that?
All right, there's several risks when it comes to international investing, but they're not as dire as you would think. And on the flip side, it's almost the same risk that we take here investing in the U.S. So when you start with a huge company, and it doesn't matter if it's domiciled here in the U.S. or it's in Switzerland or Germany or France or South Korea, they're global companies. So if you look at true international companies, there's a couple things you have to really look at. Is currencies. When currencies move, the valuation of that company changes. If it's a euro-based company and the euro goes down, well, that company's value will go down temporarily. You need to look at politics. What's going to happen with the leaders of the country that it's domiciled in, the tax consequences of any decisions made.
This is really ringing some bells when you think about what our country, what all we think about our stocks.
International investing, how strange.
Somewhere overseas, they're having the same conversation about our stocks right now.
That's right.
You know what? That's exactly right. Guess how much the S&P's revenues are derived outside of the U.S.?
How much is it?
48%.
Wow.
Holy smoke. That's almost half of its revenues. Wow.
So guess what? How much do you think international companies' revenues are derived here?
Yeah.
Almost the same amount. So, you're taking a lot of those risks and you're combining them together with what we're doing here in the U.S., and it smooths things out, because from a currency play, what one hand giveth, the other hand taketh away, and if the U.S. dollar is strong, that's going to help part of your portfolio, and if the U.S. dollar is weak, it's going to hurt the other side of the portfolio, and guess which one you want to be buying?
The hurt side.
The weak one.
The weak one, because it's going to reverse, It happens over and over and over again. And you can't tell me, no, I do not want to invest in Nestle. I hate chocolate. No, I don't want any more Sonys. I don't like any kind of electronics. Samsung, the other smartphone, do away with that. We're talking about huge global companies that invest and sell products all over the world,
right?
And there's no reason not to invest in that. No reason at all. It's
probably shouldn't let your personal feelings come into play.
Nope. Hey, now we're going back to behavioral finance.
Yeah, that's right.
That's what gets us down to that 2.11%.
Yeah, and that's interesting, because we're always chasing a bandwagon. What did good last year? What are we? And everybody. I think that's why everybody is tracked to the S&P and the Dow today, because if you look at it, really since 2009, it's been great. So, you're 7 years, 8, almost going on 8 into this market, this bull market in the S&P and the Dow. And, but, we saw some equilibrium with that last year, and I thought it was really neat. I was looking at some numbers, and I think, the S&P was up around 9% for the year last year, where the NASDAQ was up 19%. So that was a massive difference. Or not the NASDAQ, the Russell.
The Russell
was up 19.
Value.
So Russell value was up 19. So that's a huge difference in those. And we haven't seen that. The Russell's been flat, been negative, been everywhere else but up. So, and what the Russell is it's those small companies. So Aaron, talk a little bit, if you don't mind, about those small companies. What a small company actually is. Is it small? Is it something that, is it volatile? But what does it mean to your portfolio? even as a retiree, if you're 65, if you're 70, and if we get cut off by Terry here in a second, we'll just jump right back in after the break.
A small company, we're judging a company on its size. If you take all of its outstanding stock and multiply it by the stock price, that gives you its market cap, or what it would take to buy that entire company's stock. And a small company is somewhere below $2 billion.
Oh,
so
what's that make our companies?
So tiny, yeah.
And you can get down to something much smaller in the micro range, and I think micro I would probably classify that something under $800 million. But these are still large, sustainable companies. Look at Tractor Supply. There's one in every city that has Dairy Queen. So that means in every city in the United States, pretty much, and that's a small company.
Right.
That's a very small company. These are companies with sustainable revenues, priced reasonably most of the time, but they have a lot higher growth trajectory. That was a little bit of a joke about Tractor Supply, but I remember how fast you started seeing them pop up in every town.
Yeah.
That is big time growth. Walmart used to be the same way. I remember when there wasn't a Walmart everywhere.
Mm-hmm.
Or Starbucks. There used to be towns that there weren't two Starbucks side by side.
Right.
But that's not the case anymore. Now there's whole blocks of them. But the smaller a company is, the faster it can grow, and we need that in our portfolio. Over time, small companies have outperformed the S&P 500. It's called the small company effect, and it's one of the factors out there that tends to outperform over time. Now, it is a little bit more volatile.
You got a bigger roller coaster.
You got a bigger roller coaster. So when it comes to portfolio construction, you need to have enough in there to get the growth that you need, but not so much that you give up on days that are down, or months that are down, that you give up on the strategy, because that's what hurts you. That's what keeps you from getting those long-term returns.
Buy it, leave it alone, ignore it.
Right.
Don't look at it every day, or you'll drive yourself absolutely crazy.
That's exactly right.
We're going to take our final break, come back and wrap things up right here on Life Planning 101. Final segment of Life Planning 101. Lots of information to cover. Back to Angela and Aaron.
I know, we never have enough time, but tweet us. We got a Twitter poll this week at KFS Life Planning and answer. Are you afraid you're going to run out of money in retirement? Ooh, yes or no. So with that, not that he got nervous at all, picked up pens trying to figure out what he's going to say to help hedge that bet.
Answer man.
Yeah, the answer man. We'll give it to him. Aaron, we just talked before the break, constructing this portfolio of all these things. And you talked a little bit about two components, really. But, how much are you actually looking at diversification-wise when you construct a portfolio to be able to help people manage their emotions and also their goals?
Okay.
You got 3.5 minutes.
3 minutes. Well, when we're constructing a portfolio, we're trying to put together something that's going to outperform over time and get the client to the place where they need to be according to their goals. And there's lots of things to look at. And one of the biggest things we want to look at is correlations, because although it's nice to have everything in the thing that's going up at that time, most of the time it doesn't work that way. Over the long run, you have things going up and you have things going down. And we want to be able to construct it where it's a smoother ride, where people are not jumping in or jumping out because they're going to do it at the wrong time. Mm-hmm. And, that's pretty much the hardest part of my job, has been having to say, you're hurting yourself. Let's not do this. This is an emotional decision. And, we try to construct our portfolios where we don't have to have that conversation. So it does boil back down to our risk tolerances and what we can handle and our expectations. If we're expecting our portfolio to do S&P 500, well, we need to be in the S&P 500. There's going to be times that it's a lot better than that, and there's times that it's going to be worse than that. So we need to temper our expectations.
That's right. Education. Yeah. And don't forget, we've got a great article this week, kind of coincides with all this. It's called Avoid These 3 Most Common Pitfalls in Investing. I encourage you to read it. Kennedy-financial.com is where you can find that. You can actually subscribe to our newsletter, which comes out each week. And there's some great information, market commentary from Aaron, in addition to life planning information every week in there. And you can find the radio show there, as well as archived on KATX Radio and KWBYradio.com. So we appreciate everyone listening in this week. I know this has been a topic that, if we could talk for hours on this, because go in depth of each topic. And maybe what we should do this year, it is the beginning of the year, we can start new traditions, right? So every week, or every time that Aaron's on the show every month, is bring up a couple more investments and get educated better on those types of investing that are out there. So this has been really good. Thank you so much for being on the show with us this morning, Aaron, and going through all of this for our listeners.
All right, thank you.
Always great information here on Life Planning 101, and week number 2 in the books, right here on KATX KWBY.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services of Eastland. Tune in every Monday morning at 8:30 on KATX, and again on Saturday morning at 9 o'clock on KATX and KWBY for more Life Planning 101.
Advisory services offered through Smart Money Group, LLC, a registered investment advisor. Securities offered through Calton & Associates, Incorporated, member FINRA SIPC. Kennedy Financial Services, Incorporated is an independent of Calton & Associates, Incorporated, and Smart Money Group, LLC.